And then if you're like serious about it and you want to like do this business and scale, I see a lot of people I think make mistakes because they have, oh, I want a deal. Any deal is a good deal. I don't care where it's
Yeah.
located.
Yeah.
So they buy a deal in Alabama, then one in Indiana, then one in Ohio, and then one in Kentucky, and then they're spread all over with 50 unit properties all over the entire country. And it's really hard to manage that one. And then two, you've got to get a reputation in that marketplace. If you just own one little deal in this little marketplace that's only 10,000 units in that marketplace compared to like Dallas Fort Worth that's 800,000 market rate apartment units, how many units can you really grow and scale? And it's
Yeah.
not the best use of time. So if you want to be a player that owns thousands of units, generally speaking, you need to be in a major metropolitan area. Maybe you pick two or three and you focus on those. Don't focus on 20.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hey, our sponsor for the show today is Pine Financial Group, the leader in hard money lending in Colorado and Minnesota. And they were recently approved to offer their investment publicly. This investment offer is only for investors in Colorado and Minnesota and is only made through their investment prospectus. Get your copy today. Simply visit www.pineinvestments.com and click to get started. Look, there's a reason why some of the wealthiest people in history invest in loans backed by real estate. Learn more about the risks and returns at www.pineinvestments.com. Hey, welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me today, I'm excited to have Michael Becker. Michael, how are you doing today?
Todd, doing good. How are you?
I am fantastic, and thanks for joining me. Michael Becker is a principal at SPI Advisory, LLC, and heads SPI's Dallas, Texas office. SPI Advisory specializes in repositioning multifamily assets. Through professional asset management and a high level of integrity, SPI Advisors increases the value of properties while improving quality life for its residents. And I'll let Michael kind of go a little bit more in depth with SPI, but before we let him talk, they have done it in the last 6 years approximately, about 9,000 units in the Dallas, Fort Worth, and Austin markets. And prior to that, Michael was a 15-year veteran commercial real estate banker and originated probably a lot of mortgages. So, Michael, with that said, why don't you give our listeners a little bit more about your background and then your focus today and kind of what you're doing?
Well, thanks for having me, Todd. As you mentioned, I'm based principal at SPI Advisory. I'm based in Dallas and head up our Dallas Fort Worth office. And my business partner Sean runs our Austin office. But prior to getting into the business, as you mentioned, I was a longtime commercial real estate lender, and really the last 6 or 7 years of my commercial banking job, I focused on pretty much exclusively value add multifamily lending. So I would just helped a lot of these deals coming out of the recession, built a bridge program out and kind of helped them put Humpty Dumpty back together again, I guess, is what we did with my product. And kind of through that process, just realized I was on the wrong side of all those deals. So it's kind of better to be the borrower than the lender. So I went out and started in 2010 or 2011, started buying some smaller stuff with my own money. And realized that wasn't very scalable after doing about 15 or 16 rent houses. So I transitioned over and kind of reflected back to what I was doing all day, every day at work. And we started doing some larger scale multifamily deals. So kind of as of we record this today, I think we just closed on a 39th property, 38th to 39th property, just shy of 9,000 units. We sold several of them now, kind of full cycle on 17 deals. I think we've gone full cycle on now. We've sold 13, and we've had 4 more that we've refinanced, returned some capital, still own. So as we talk right now, we're just under 6,000 units. I wish I should know exactly what the number is, but it's like 5,900 units, somewhere in that kind of ballpark. And as you mentioned, we focused, predominantly on Dallas Fort Worth, and then we went to Austin about a year ago. So we have about 900 or so units in Austin, and everything else is pretty much up in North Texas where I live. So excited to have be on here and try to share a little bit of knowledge on kind of how we got from 0 to almost 6,000 today.
Yeah, and that's where I want to go next because I think a lot of listeners probably heard you and just went, "Holy cow!" Like, how do you have? How have you done 9,000 units? You currently own about 6,000. Like, what the heck did you do in that short of a period of time in order to get that? So, let's talk about that. Let's talk about what did you do to be able to scale up so quickly and start from essentially zero to now having 6,000 units under
Yeah.
management.
Yeah. So when we started out, I had a lot of things at my disposal. So, I had a little bit of monies because I was a pretty successful banker. So I lived below my means and saved my pennies. So I had a little bit of money, but certainly was not wealthy by any stretch of the imagination. But what I really had was I had a lot of relationships and I had a lot of experience underwriting deals because, professionally all day, every day, I would just underwrite deal after deal, as well as I'd have to manage the portfolio. So I got to kind of see what my clients did. Some did good things and some did bad things, and kind of observe without having any risk capital. And then I also had a lot of relationships, so I knew a lot of the management companies, a lot of the contractors by just approving the draws, as well as I knew a lot of the bankers because I was a pretty prominent. A lot of the brokers as a pretty prominent banker in Dallas, and I did a lot of loans I made were on properties they sold, so they wouldn't get paid till my loan funded. So everyone kind of knew who I was. What I needed to do was I needed to kind of change the perception of the marketplace for Michael Becker. So the marketplace saw me as a banker, not as a principal, and those are definitely two different things. So
Yep.
the way I basically got started was I met my now business partner Sean when I was working for the bank. He was working for a broker out of Beverly Hills that helped high net worth individuals in LA and Orange County buy properties in Texas. I made a loan to one of their clients, flew out to meet his client, and that's kind of how we met. So what they started doing was had a local kind of operator put a little bit of money in these deals and kind of serve as the boots on the ground for the equity out of California. And they were working with a guy who kind of ran out of money, and I kind of knew that, so I was there raising my hand like, hey, I can do that. So really we ended up doing 4 deals, about 800 units in 6 months out of the gate while I still worked at the bank. I put about 5% of the money required in, and they would put 95% of the money in. And basically, what I really did was I just took a pretty small piece of the pie. Basically, I put 5% in, 10% ownership, and a small asset management fee, which is not a whole lot of equity for the amount of work that you do. But
Right.
what I was really focused on, Todd, was I kind of made a decision to get out of the bank, and I was going to do that orderly over 6 to 9 months. And if I knew if I could change the perception of the marketplace from a banker to a principal, I can just kind of take off from there, which is exactly what we did. So taking 800 units down in 6 months, they change the perception in the marketplace pretty quick. Really, once you do your first deal, it's kind of you're proven commodity to a certain extent. If you can do 4 of them, you kind of become a player at that point.
Yep. Yep. So what was to get to continue to buy those units? Obviously, it wasn't just deals. Were deals just falling on your lap? Was this that easy? Investors are falling out of the sky, or how did that
So
all?
so at first, what we also had was Sean took a really large investor from his previous company,
Okay.
and so these deals were easier from the standpoint. We were buying C-class properties that were in the 20s or maybe low 30s thousands of units
Mm.
back in 2013, and then you fast forward today, those same properties are 80 to 100,000 a unit. So the total dollars were so much lower, so the amount of equity, $1 to $2 million kind of equity checks that these exact same properties today would take, $7 or $8 million in equity to get done. So one, the hurdle was a little bit lower. Two, we were willing to work for a little bit less to start to kind of delay a little bit of gratification. So again, I would just focus on doing good quality deals and returning capital and building my reputation out. So that was really my primary focus. It wasn't as much as making as much money as possible, because I knew that would follow if we can do these well and kind of set my career up. And then two, we were fortunate enough to have one equity partner that was crazy enough to give us a bunch of money for the first several deals that we did, and he would help us kind of front some of the pursuit costs, as well as be our equity partner, as well as sign on the loan, since he owned 90% of the deal. he would sign on the loan as well. So we helped qualify for the mortgages that we got, as well as kind of front the 100,000 or whatever in pursuit costs that we needed for earnest money and fronting the lawyer and things along those lines. So that was really helpful. You know, what we needed to do, the deals were a little easier to find from the standpoint it wasn't quite as wasn't as hyper competitive, and you didn't have to go hard at it with day one with earnest money and all the crazy stuff you have to do today to kind of get some of these deals awarded in most of the major metropolitan areas across the country.
Yeah. What what are you doing today to find deals? Because you're in Dallas, Fort Worth, you're in
Yeah,
Austin, two like
hyper
markets that
competitive.
are
Yeah,
absolutely on fire. I mean, I'm not in either of those markets, but I know people that are, and and you hear about it. I mean, you can't
sure.
just not hear about it. So those are hot markets first of all. So how do you find the brokers, or how do you find the deals? And then with that, how do you make sure you're not overpaying for deals? Because as you just said, you were buying properties for $30,000 a unit. Now they're at $100,000 a unit. Those same types of properties. How do you make sure you're actually not overpaying for these deals? You want to keep
Sure.
on growing and expanding your business. You just closed on some deals, so obviously you're still doing business. Um, Explain kind of some of that for me.
Yeah, I mean, now everything's exponentially easier from the standpoint of, I think we, like I said, we closed like our 39th or 40th deal or something. So at this point, we're pretty well a fixture in the marketplace over the cycle.
Yep.
So everyone knows who we are. I mean, they kind of knew who I was before, but everyone knows who we are. So we're players and we have a good reputation. So I think with that, you kind of get your unfair share of deals. That's one of the things I like to say. It's a completely unfair business. A lot of it's who you know, what chips you can trade, what track record you have with all that
Yep.
stuff comes into play. So if I'm bidding on a deal versus a guy that owns one or two deals in the marketplace, the seller's naturally going to want to gravitate towards me, assuming price and terms are equal, just because I've done whatever 20x or whatever they have in transactions. So
Yep.
I'm much more of a sure bet than say you, if you're coming to this marketplace, even if you own another market, they don't necessarily know who you are.
Yep.
It's just so that helps, right? One. Two, we're pretty active. I mean, we try to look at literally everything, on market, off market, doesn't matter. We look at everything, and we just kind of scour and try to find deals. So we're just looking at a lot of stuff. We're looking at more stuff than what we used to find one that makes sense. A couple other thoughts. One, you're having to adjust your expectations down, in particular for like returns. These first deals we did, I think we pro forma, 22, 23% IRRs and,
Mm.
10, 11% cash on cash pretty much out of the gate. And then when at the end of the day, when we sold them, I think we're like 60 IRRs and, killed it. I mean, every deal, like, we did a good job. We bought right. But then the market rents kept going up and cap rates
Yeah.
compressed. And I looked like a genius to triple your money in 2 years on many deals. And that's just not the fact of life today. That's just not practical to think that that's the state of the market today, nor can you continue to expect to have a lot of cap rate compression and overheated market rental rate growth. It's just not going to happen most likely. So, what we used to project 22s and delivered 60s, now we're projecting 14 and 15 IRRs, and we'll probably hopefully produce 14 and 15 IRRs because that's just a function of the marketplace. Again, and a couple other things too. As you get bigger, as you do more deals, you get better pricing, especially when it comes around debt. So, some of these deals, we just closed a loan that we got a 30-day, we did a floater. So we did a 30-day LIBOR plus 156. So,
Mm.
that today is like a 3.8 pay rate. And, if we weren't who we are, it would have been, probably 30-day LIBOR plus 180 or 185.
Yep.
So, we probably got 30 bips off just by being a repeat large client. So, as I say, it's an unfair business. If I can get 30 basis points lower on my debt quote than say the next guy, my math looks better just by function of having better pricing. Or if they give me an extra year or two of interest only, it helps your cash on cash returns relative to the next buyer. So we have a little bit of an unfair advantage from that standpoint, depending on who the competitor is. If I'm competing against like a Blackstone or some firm that owns 100,000 units, then we're relatively small compared to them. And you can extrapolate that out to like insurance is another good example of that.
Yep.
So if I have a big insurance portfolio policy, I get better insurance pricing, and I can save $30 a unit in insurance pricing compared to the next guy. That just helps everything out. So all those things. Then how do you help to not overpay? I mean, quite honestly, I think everyone that's doing deals now is probably slightly overpaying, and that's just kind of the function of the marketplace. So you got to make sure that you're buying deals that have clearly and well located locations, that have prospects of future rental rate growth, and that you have clear documented upside today. That the rental rates of the neighboring competitor set have $100 higher rents, and if I just go in and upgrade my interiors or upgrade my office area, make it look like that property, I can push my rents up to there, and then by extension, I increase the value. That is certainly something. And then, quite frankly, just the bigger we get, and the more we do, we're going up the food chain. Because what I've really observed over the last 6 years, it's just the cap rates from the brand new top of the market Class A to the C used to be wider spread between delta between the two. Now they're pretty much on top of themselves. So, like for example, if you go back when I first started in 2013, Dallas Fort Worth, you could buy a brand new Class A deal for about a 5 cap. A B deal was about 6.5 cap or so, and a C deal was somewhere between 8 and 8.5 cap. Fast forward to today, a brand new Class A deal is like a 4.75, a B deal is like a 5, and a C deal is like 5.25, or something like that. So what used to be 350 basis points of a spread is now within certainly a percentage point, from brand new top of the market to kind of the lower property grades. So as I see that kind of the market change, it doesn't make as much sense to me to pay the same basic cap rate for a 1974 piece of crap building that I can for a 2004 vintage deal that is 30 years newer. So they're basically the same cap rate, and I have $100 rental rate upside on both of them. Really, the only difference is kind of the purchase price, because the rents tend to be higher on the newer stuff. And so you, instead of raising $5 million, you have to raise $15 million, and
Yep.
we have the ability to do that now. So we'll just go ahead and buy the bigger and better quality stuff. So I don't know if that answers your question, but those are kind of my rambling thoughts around what you asked me.
Yeah, and it's interesting when you talk about the cap rate, and I think that's very similar in most markets. And in my opinion, when I'm looking at a lot of these deals, I'm going, man, we you worry about these cap rate compression that has happened, and what'll happen when the market eventually does take a cycle, and will cap rates at these C class properties go from being at that 5.5 or whatever they're at to back to that 8?
Yeah.
When you look at where the A class is, as you said, what used to be a 5, now it's a 4.75, maybe a 4.5. Well, that's not a lot of adjustment
Yeah.
to go back to kind of historicals. So the A class and the B class, to maybe a little lesser extent, they have less room to fall
Yeah.
than the C class potentially.
And I think the other thing that younger syndicators, and we've been kind of the beneficiary of this as well. I think what a lot of people kind of don't take properly into account is these older deals. You have something built in the 1970s, you tend to have like cast iron sewers, boilers, maybe a chiller, asphalt parking lot. So you come in, you buy a deal, you put aside 5 or 6 thousand a unit, you renovate the property, and then magically over the last this entire cycle, you can sell your property 2 or 3 years later, and then the next guy comes in with more capital to do the 2.0 renovation, and they fix it and they sell it again 2 or 3 years later. So what happens when you get stuck in a cycle and you got to own that 1970s deal for 5 or 6 years when you only set aside enough money to renovate it once? So what I like to say is these older deals, they're just kind of functionally obsolescent with a lot of their construction components.
Yeah.
So these cast iron sewers that are 10 feet underground, they tend to kind of erode over time. You have a sewer line collapse, cost you 10 or 15 grand. Have a plumber dig under your building, replace 10 feet of sewer line, and put it back together. And so that doesn't that's a capital item. So it's kind of below the net NOI line. So it's booked as a capital expenditure, but it's a real use of cash. So
Yep.
if you don't have that money set aside, and these things tend to happen on a more frequent basis, the older the asset, it's just kind of a function of just got to maintain these things. So I
Right.
don't think people are properly accounting for that when you actually have to own it for a long period of time, and they're out there just trying to make sure that you show a return of capital to your investors, and because you have this pressure to deliver because you projected to have a 6% cash on cash year one, and 8 year two, or whatever it is. So you're distributing your money, and maybe you're not properly keeping back some reserves or items like that. And you're more susceptible to have issues like that on the older deals. So I'm
Yeah.
a little worried about that for some of these guys kind of getting into the business. So don't think through that a little bit.
Yeah, I couldn't agree more. I've had some older buildings, and they definitely just inherently have more problems with, especially with some of the systems. Your plumbing systems, your electrical systems, your HVAC systems. They just those only have a certain life expectancy, and
Yep.
and most of those buildings, especially if you're buying a 60s or 70s product, you're at the life expectancy. It's no longer, any day you have beyond is a actually you're getting a gift, really. And so
Yeah, for sure.
you got to expect that stuff to break down. Hey, let's take a minute to thank our sponsor, Pine Financial Group. Look, you work hard for your money. Is your money working hard for you? Because of inflation, money sitting idle erodes your wealth. Many investors understand that real estate is a great investment, but may not want the effort or the risk that comes with owning their own property. They want to sit back and have payments hit their bank account each and every month. Stop eroding your wealth and start building it by asking your money to work for you. You should be earning profits while you sleep, an investment backed by real estate. Pine Financial Group, the leader in hard money lending in Colorado and Minnesota, was recently approved to offer their investment publicly. This investment offer is only for investors in Colorado and Minnesota and is only made through the investment prospectus. Get your copy today. Simply visit www.pineinvestments.com and click to get started. There's a reason why some of the wealthiest people in history invest in loans backed by real estate. Learn more about the risks and returns at www.pineinvestments.com. It's www.pineinvestments.com. You've got these properties now. I want to talk about the success of your business and what are some things that you can give to our listeners to operate a business successfully? What are the things that maybe you've done, and as a banker, you've seen other companies do that really allow them to be successful?
So I wish I was more intentional from when I started out. So we kind of fell backwards and got a little fortunate on some of the stuff. But really when we started rolling, we had I had a business partner, and we had basically one employee when we started. And then now there's a total of 10 of us in our company. So we have my partner and I and 8 employees, and we employ a third party management company to do the day-to-day property management of the assets. So we've been able to scale up with relatively small staff. I mean, if we self-manage and we're fully vertically integrated, we'd probably be 200 employees or something
Right.
like that today if you had to have all the on-site staff, the regional accounting and HR and all
Right.
that stuff that comes with a management company. I think one of the things we did well was I picked a business partner that had a completely different skill set to mine. So he's like the most brilliant guy when it comes to doing spreadsheets and analytical work, and he's got a really good sense of negotiation about him. I'm not saying I can't do a spreadsheet; I'm just not quite as good. But he's not very outgoing when it comes to talking to people and presenting and things like that. So that's kind of really my role, is kind of focus on investor relations and networking with a lot of the brokers and things like that, and kind of oversee asset management, where he's kind of more on the transactional side and underwriting. So by having, if you can partner up with somebody, by having somebody that has a different skill set to you that complements yours, you don't do twice the amount of work. You do 3, 4, 5 times the amount of work, because you can do what you do well, and just focus on that while someone else does the other things, versus you having to struggle and spend a bunch of time on something that maybe you're okay at, but not as proficient as the next person. So
Yep.
by kind of making sure, if you find your buddy and you guys are exactly the same, you have the same skill sets, it's probably not the best business partner could go into business with. So that'd be one tip I think that we've been, was unintentional. I didn't really sit out and think through that when I made my decision on who my business partner was, but with the benefit of several years of hindsight, that's been a really good decision. And then the other thing that we've chose to do, which I think a lot of people at least start out that way, is do the third party management. Because I really want to focus on finding deals. You got to find deals and find money. That's kind of how you make money in this business. You got to find capital, find deals. Everything else is sort of noise. It's all really important. You got to operate. You gotta, be able to, communicate. You got to operate, execute the operationally as well as with your business plan. You got to buy right. You got to put the right debt on it. But really the way you get paid is finding deals and finding money. So that allows us more time to focus on that and network with brokers and talk to investors and things along that ilk. And I'm not like bogged down in much in like some HR issue on my site because the management company handles most of that. Then as we started growing and getting more asset management fee income, then we just started scaling up with layers of employees below us. Getting operational help, making sure we have asset management help, making sure that we have administrative help, making sure that we start hiring in or buying software to help kind of scale some of the stuff. An investor, we started out, our investor database was Google Sheets and Excel sheets. And then now we have a centralized investor data base with an investor portal that our investors can log in and it helps us raise money. And we're a lot more efficient that way, but it costs $2,000 a month, and you can't afford that when you start out. You don't have
Right.
you have zero in asset management fee income coming in. So as you start getting make sure when you're doing deals, you're getting asset management fee income because you're going to need that to support all the operational people. Because even to this day, I think even with all the assets we have, we still have more overhead than we do asset management fee income coming in on a monthly basis. So we're still having to either do deals to kind of cover up the deficit and the overhead, or use some of the free cash flow off the properties that our ownership percentage gets to support it. So we're constantly trying to make sure we're having robust infrastructure in place so we can service everything. Just kind of start thinking through that as you're growing. If you guys are legitimately serious about trying to grow and scale into a company of size with a couple thousand units or more, you need to kind of think through, okay, I need to start here, and then because you're never gonna have a perfect your amount of expenses and the revenue come in are always kind of going back and forth a little bit. So sometimes you have enough properties coming in that you have enough revenue, but you don't have enough team members to pay for it, so you got too much work to do it. So then you'll hire somebody, and now you have more expenses than what you do income coming in. So you go buy some more properties, and you're constantly toggling back and forth. And that's just kind of, I think, the life of a small business owner, and that's kind of how it goes until you get a certain scale.
Yeah, I like that you talked about the asset management fee because a lot of people don't really, in my opinion, understand really what it is that are in this business that, especially that don't have the experience as you do. A lot of people look at that asset management fee as an actual income source, and I think that's obviously the wrong way to be looking at it. You should be using that asset management fee to uh, grow your business, to make sure the assets actually being managed properly, versus thinking of it as something you're going to put in your account
Yeah,
and save.
live off of, right? Yeah.
Yeah, yeah, and a lot of people do. I hear a lot of people talking about that. Oh, it'd be great to have this asset management fee because then I'm making 30, 40, whatever $1,000 it is, and it's like, well, no, you're not making anything. That's supposed to be a break even deal, and
Yeah.
and if it's not, you're probably needing to add something into your business. Um, talk about a mistake. What's a mistake that you've made, and how have you learned and grown from that?
So we've been fortunate to not make any like major fatal mistakes, but the market's been so damn good that even people, I'm sure any mistakes I made for the most part have been covered up. The one thing that does the biggest thing I think we've kind of made a mistake on, certainly with the benefit of hindsight, was that a lot of the first multiple years of us doing this business, we did a lot of long-term 10-year fixed rate money.
Mm.
And there's nothing necessarily wrong per se with that, but what comes with a 10-year fixed rate loan was a large either what they call defeasance prepayment penalty or yield
Yeah,
maintenance prepayment penalty. So it's a really large thing. So the thought process of the time was a little more risk with the leverage. So let's take out the risk of the refinance by having a long-term fixed rate. And we're going to borrow money at 5%. And at some point, the rates are going to go up. And then the next buyer can come in and assume our mortgage at a below market rate. And I'll be accretive to my situation. So what happened was the rates have done nothing but stay flat or go down. And then when you go sell it, you're having to that loan, instead of being an asset, it's a liability. So either you got to come in, someone assume it, because we only had 1 year of interest only when we did a lot of these loans to start. Now you get
sure.
5 or 6 years of
Yep.
interest only is pretty readily available in today's marketplace. So it impacts the buyer's cash on cash. And then two, you have an above market interest rate. So either you got to have them come assume it, which affects their economics, and or you got to suck it up and take a multiple $1 million prepayment penalty to offset it. And that's fine if we were in these deals for thought that we were going to be in these deals for 10 years, but we were going in these deals thinking we can get out in 3 to 5 years, and we still put the long-term fixed rate down. So we didn't do for the sense of safety. It was really kind of certainly counterproductive, because if we just would have put something with a flexible prepayment penalty on it, knowing we're going to be in and out of these things in 2 years, we could have either implemented the plan and worked to refinance it after that when our prepay either burns down or burns off all completely, and or just go out and sell it. So that was one of the things. I didn't think we thought we were being smart, and that we kind of have our cake and eat it too by having the debt that's assumable and be accretive, but it turned out to come back and bite us. And that's certainly why we've done really, really well. We would have done that much better if we didn't have to deal with these very, very large prepayment penalties along the way.
Yeah, and it's interest rates. I think ever since I've been in the business, people have been talking about how interest rates are going up. And they're eventually going to go up. And like you said, they've either been flat or gone down. And yeah, we've seen some maybe slight adjustments one way or the other, but it's basically overall since 2008 gone down. So what type of loan are you putting on your properties today?
So
Or is
it
it
depends. The most recent, we've done a few things. So here, like I said, we started out with basically 10-year Fannie Mae money. That was pretty typical for the first however many 15, 20 deals we did. And then we kind of got stuck a couple deals around the election time where we were in escrow and weren't rate locked. So the rates started going up, and then we ended up rate locking higher, and our loan proceeds got cut. And that was a pretty rough time about 3 years ago when after the election in 2016. If you guys flash back to what happened in the capital markets, that was tough. So we pivoted and said, okay, we got stuck on a few of these deals. Let's go out. We started specifically targeting a lot of properties that had loan assumptions available. So we knew we got some issues. So let's go try to take these people that maybe have 6 years left on their loan, or 7 years left, or whatever it is, 5 years
Sure.
left. Let's go do a loan assumption. So the seller will avoid that large prepayment penalty. So we'll pass all, or at least the vast majority of the savings they get from not having to pay the yield maintenance, pass that along to us as the buyer. We assume the mortgage. We had to put a little bit more down, and we give up some interest only, but we save maybe $1 million or $2 million off the purchase price.
Yep.
We use that loan assumption like a bridge loan, effectively, where we come, we take it over, we reposition the property over the first 2 or 3 years, and the term goes from 6 years to maybe 3 years left. And then the way the formula works, the prepayment penalty burns down. So instead of having a $2 million prepay, maybe we pay 600,000 or something down the road. And then, but in the meantime, we forced the NOI up and the value up. And so we did quite a few of those, and you had a little less competition on these loan assumptions, because just what I was saying, it kind of hurts your economics a little bit as a buyer. So got real successful doing that. And then we had a handful of, there's a handful of non-recourse bridge programs out there as well. So we used a regional bank here, and we did 4 or 5 loans with them. They had a non-recourse bridge loan that would give, either between 70 and 75% of cost. And then here, most recently, we kind of have done historically a lot of stuff with Fannie Mae and Freddie Mac. The bigger we got, Freddie Mac actually came calling on us, and they had a floating rate kind of ARM program. So you take a 10-year loan, you get 5 years interest only, and then you have a LIBOR plus a spread product. So the way we did it, you locked out for a year, and then it's a 1% prepay thereafter. So we've done several deals like that here recently, kind of a LIBOR floating Freddie Mac loan with a 10-year term, 5-year IO. So that's kind of a little bit of both worlds. That you have a long maturity, you have enough IO, but you have flexibility on your prepay, and they waive the 1 point exit if you refinance it with Freddie Mac into a long-term fixed rate loan. So we've done some of that. So we're just really trying to be a little bit better about fitting our debt with the exit
model.
and if we're taking a little bit of interest rate risk, meaning that we're not having long-term fixed rate loan, what we're doing is we're kind of scaling back the leverage a little bit, where we used to do everything around 80%, and then things started getting tighter, so most stuff was about 75. Now we're somewhere between 65 and 70. So most of these deals, loan to value. So think about 1/3 equity, about 2/3 debt, somewhere in that kind of general ballpark is what most of the deals are doing today. So if we have to refinance it, we have a little bit more margin of error from a loan to cost perspective on the front end.
Yeah. Are you doing a cap on your rate?
Yeah, they make you buy a LIBOR
cap.
cap. So they make you buy a 3-year LIBOR cap with max strike rate. And what's happened as we're the end of July as we record this 2019. So what's happened in the marketplace over the last several months is these as the Fed is expected to cut rates tomorrow. So we'll see if they cut it a quarter or a half. That's a big thing in late July 2019. So LIBOR has been come down quite a bit, and the expectations of the marketplace is that LIBOR is going to be lower than what it is today for the foreseeable next couple years. So these caps are so inexpensive. I just actually rate capped a deal today, a $22 million loan, and our rate cap for 3 years was like $18,000. So it was, and we pro forma 2 months ago, $75,000. So, we came in way inside of that because everyone in the marketplace feels that LIBOR is going to do nothing. So if LIBOR drops, our pay rate drops as well in our loans. We should see materially significant savings on our interest expense.
Yeah, definitely. I've got a couple deals I did some bridge on, and when I purchased them, I underwrote at 6% interest rate locking in, and we're getting close to being at the refinance state probably here at the end of the year. And I'm pretty excited because it makes the numbers look a lot better. Yeah.
That's right. That's right. Yeah. So I'd race to get your property ready to go and take advantage of it while you can.
Yeah. Yeah. So what advice would you give our listeners who are just getting started? Obviously you started in a different position than some people that are listening are starting, but let's just talk to as many people as we possibly can. How do we get started in this business?
Yeah, a couple of things I would give as advice. I mean, first and foremost, you need to, kind of take a personal assessment of yourself and kind of get real with what you have. So, you have, a certain level of financial resources. Everyone's financial resources are a little bit different, as well as you have, certain level of relationships or lack of, or you live in a small town, middle of nowhere, you live in a major metropolitan area, or whatever your situation is. So just to be, do a personal stalk of yourself, and then, so where you're starting with, and just be realistic about it, and then take steps accordingly. But, the first and foremost thing you need to do is get educated. So, I was fortunate from the standpoint that I had a job that paid me to get educated and learn the business, where, most people don't, right? So if you're an engineer, or if you're like an engineer, an IT engineer, or you're a salesperson or whatever you are, that is kind of what it is. You have these certain professional skill sets that, maybe I didn't have. So there's a lot of good reputable programs out there. So join up with there's a lot of mentoring programs that you can join up with. And if done right, I've seen a lot of people be extremely successful. It's not so much just the education you get, which is important. You get education on podcasts like this or reading books. And these are, as you're starting out, if you don't have much money, that's what I would start with. Just listen to every free podcast you can.
Yeah.
Watch a bunch of webinars, read several books, things like that. Base level education while you save money and try to accumulate some capital. And then 2, you can then join some of these groups, some free meetups and things like that. Or if you actually have some money, you can just pay 20 grand, join a group and get there. And then once you're in there, you start network. So, find out what you need. So just a puzzle in the way I kind of look at it, do a deal. So like you got all these little pieces, you just kind of got to put it together and make sure it's clear. So if you have some money and you don't have experience, you find a partner that's done a deal or two that maybe you could partner up with, help them front some pursuit cost, whatever. And that's a way to kind of get entree into a deal. Or if you have some experience and no money, then, that's kind of the opposite of it. And then you need to make sure you network with passive investors. If you're going to be an apartment syndicator, so make sure you always need money and you do that ahead of time. So when you have a deal, it's not the time to start looking for money. You need to start working on that, building your list out, build your database out, whether that's a robust database like I have or a Google sheet with a name, email, phone number, and kind of where you met them with some notes. Just kind of start with something simple. Make sure you document everything and date when you did it, so you kind of have a reference point. And then keep staying in front of them. That's a good way of doing it. And then the other part of it is you got to get networked with deals. If you want to be a sponsor to get some deal flow, then you need to get on all the list, right? So
Yeah.
whatever metropolitan area or areas you want to be active in and look at deals, find out who the brokers are that do deals in that area, and make sure you sign up for Marcus and Millard, Chatham, Berkadia, Newmark, and whoever else in CBRE, whatever in your market. And each market is different because this group in this town, is a Berkadia town, and that group is a CBRE town, or whoever. They got the pecking order. And then make sure you sign up for all the lists, start underwriting deals. Make sure once you get educated, then you start reaching out to these brokers, start kind of scheduling tours, go on tours, underwrite deals, give the brokers feedback. Do things like that. One of the sayings I like to say is, this is not a business you can do at your desk or at home. You got to get out, you got to get to know people, you got to get networked. So one of the examples I like to use, like in Dallas, Fort Worth, and then most of the major cities across the country, Marcus and Millichap is a big investment sales apartment broker in many markets. And they'll have a big multifamily conference in the fall in Dallas in October every single year.
Yep.
And they do the same thing in Houston, New York, wherever. So who's going to be there is every broker in that city for Marcus and Millichap. So what you can do is go spend $300, buy a ticket, go to the conference, and then all those guys are going to be there. So that's a good way to kind of get out, meet these people, get networked. Because if they don't know, like, and trust you, they're not going to do business with you.
Yep.
So that's kind of the early grounds. But I wouldn't do that until at least you have a base level education. Because if you come in and you don't understand what the hell you're talking about, they're going to pick you out as a fraud, and then it's going to come back.
It sets you back years.
Yeah. So those are kind of the basic things as we're getting out there, and so education, networking, both with the passive investors and with brokers, and they go to two separate events. So you need to kind of make sure you're specifically targeting both of them. Yep. And making sure that you're do what you say you're going to do, follow up with people, both investors and with the brokers. And those are kind of some, and then finally, I guess, just don't be a jerk. People like to because of people they like. So if you're rude and you're always trying to pick people apart and things like that, that just tends to not work very well.
Yeah, it's a small industry, and it seems like it shouldn't be, but it's a small industry. There's not, if any particular town, there's not that many of the main players. There's some other people that dabble, but as far as the main players go, especially, it's just a small market.
And then if you're like serious about it and you want to like do this business in scale, I see a lot of people I think make mistakes because they have I want a deal. Any deal is a good deal. I don't care where it's located.
Yeah.
So they buy a deal in Alabama, then one in Indiana, then one in Ohio, and then one in Kentucky, and then they're spread all over with 50 unit properties all over the entire country. And it's really hard to manage that, one. And then two, you've got to get a reputation in that marketplace. If you just own one little deal in this little marketplace that has only 10,000 units in that marketplace compared to like Dallas Fort Worth has 800,000 market rate apartment units, how many units can you really grow and scale? And it's not the best use of time. So if you want to be a player that owns thousands of units, generally speaking, you need to be in a major metropolitan area. Maybe you pick two or three and you focus on those. Don't focus on 20. So focus on one or two to start. And then once you get a good foothold, you can then, from that point, you can then, so I was in Dallas. We did a bunch of stuff in Dallas, and we did that for 5 years. And then we went to Austin, where we had a physical presence. And that's a natural expansion for us because it's 3 hours away, and a lot of people own in both markets. And maybe we go to Houston, or maybe we go to, Phoenix or Atlanta or wherever we go. But, we have our stronghold and at home. In our backyards. But if you live in a place where home isn't favorable, you live in LA and you can't make it make sense, maybe focus on Phoenix or focus on, wherever, Atlanta or Salt Lake City or some market like
but
that.
make 1 or 2 markets your focus, not 10 markets, right. 20 markets, especially.
And it's easier for me because I get in my car and go drive and look at something. If you got to get on a plane, that's harder, especially
challenging.
Kids and things like that. Life kind of gets in the way. So, just don't spread yourself too thin if you really, really want to be serious about this business. I think that's a mistake a lot of people do.
Yeah, I agree 100%. A lot of things you said there, I think anybody who's newer in this business needs to rewind the last about 5 minutes and listen to that again, because there's a lot of really good nuggets in there. I do some coaching, and a lot of the mistakes, or a lot of the things that you said, I see a lot of people making those mistakes. A lot of people don't do that personal assessment. They don't understand really where they're at. They think they can go out and get this property under contract, 200 unit property, and raise money for it. And they have very little network. They can maybe raise, $100,000 or $200,000. They have literally no net worth, and they have no money in their bank account. And you go, well, what are you going to do? You can't do this deal. Unfortunately, it takes money to do a deal, whether you get this thing under contract or not. Likely, you're not going to ever get it under contract. But you have to have a plan in place. It doesn't mean that you can't do the deal. You just have to understand what you're missing.
Yeah.
And so we have to fill those gaps in order to do that deal. And that's where the education that you talked about comes in hand. And I really appreciate that you talked about getting educated and waiting to talk to brokers, because that's something I preach a lot. Is a lot of people want to reach out to the brokers. That's their first thing they do because they hear it's super important, which it is. But if you're reaching out to these brokers and you don't know what a cap rate is, and you don't know IRR, and you don't know like a lot of these terms, the broker's going to sniff you out real quick, like you mentioned. Yeah, and you just lost your reputation, or you gained a reputation you don't want, and they're not going to do business with you. So
I think the other thing along those lines too, as another like little pro tip, if you're starting out, you go to your town and CBRE is the big shop in town. So all these brokers work as teams. So it's not one broker.
Yeah.
It's usually a senior. Maybe if it's a bigger team, you have a couple like more senior level guys. There's the main guy, a few senior level guys, and then a bunch of junior guys that are kind of starting out. So you don't want to come in swinging at the king of the group. If you're coming in, you start kind of find out who the junior guy is, the guy that they send to go do all the tours of people they don't know. Start trying to build a relationship with them, because that junior broker's hungry and trying to build relationships, work his or her way up the food chain. So I think that would be
great advice.
25-year-old is who you should talk to, not the 55-year-old when you're starting out in this business.
Yeah, that's great advice, excellent advice. Likely also the 25-year-old isn't going to be oftentimes around in that. So if you do make a fool of yourself, you can recover from it a little quicker too.
That's right.
You can wait for 6 months and talk to the next 25-year-old that gets hired. So, but yeah, that's fantastic advice too, because the senior broker is just not going to want to talk to you if you don't.
Yeah, because they've done 10 deals with a guy like me, and why the hell they want to talk to you? They're just going to call me.
Yeah. Awesome. Well, you know what? I could probably keep on going on with this conversation for a while, but I want to respect your time. So I want to wrap up. I got a couple questions to wrap with. First of all, what is a daily habit that you do for success?
Daily habit I do for success. So, I always try to, I tend to go down the rabbit hole sometimes. I mean, we're pretty productive, but, what I will always try to do is make sure I do a good job of trying to prioritize what's the most important thing I need to accomplish that day. And I do my best. So I'm not perfect about it, but I do my best to try to prioritize those things. And I also try to, make it a point to think about, I have 1,000 things on my to-do list at any one given time, and I just need to make sure that I'm prioritizing the ones that either find deals or find money. So you talk to
Yeah.
investors, talk to
Yeah.
brokers, things along those natures, because I could get stuck at doing some crazy administrative tasks that maybe makes you feel better, but it's not really at the end of the day gonna help you achieve my goals. So just making sure I just do a good job to prioritize what's really needs to be done and what would be nice to get done.
Yeah, definitely. Excellent. How do you like to give back?
I like so a couple things. I mean, really kind of the biggest thing is I like to kind of help people that are getting started out. I don't have a coaching program or anything like that, but I like to do podcast and like yourselves, or we actually co-host a podcast called the Old Capital Real Estate Investing Podcast. So you can
Yep.
find that on iTunes or Stitcher or probably anywhere that you're listening to me right now. If you just type in Old Capital, you'll find that on there, or you go to oldcapitalpodcast.com. So there we just do podcasts and talk about apartment investing, and it's a really kind of a niche topic here. So if you're an apartment nerd, it's the one for you. If you don't like apartments, we don't kind of go all over the map. It's very very focused, but it's pretty meaty type stuff. So it's not
Yep.
very fluffy. So if you're trying to learn, that's a good way of trying to do that. So just trying to make sure. Why I've only been owning apartments for 6 years is I was a long time banker, and I guess 2019. So a decade, 10 to 12 years ago, I was a grim reaper punching people's lights out. So I have a lot of lessons I learned from there. So I always try to make sure that I let people know that this has been a great environment that we've been in, but trees don't grow to the sky. So
Right.
you kind of make some of these similar mistakes. At some point, it's going to cycle, and right now everything's going up, so you're going to cover up every single mistake that you make. But at some point, that if you make a poor decision, all this can come back and have a repercussion. So trying to impart some wisdom that I have, and a lot of people that we have on, just kind of what we saw happen, and maybe ways to structurally set your deal up to mitigate a lot of those risks.
Yeah, definitely. Cool. What's your favorite book, business or real estate related?
Really, my buddy kind of became buddies with him, Ken McElroy. I like his two
Yeah,
books.
I
He's got
like
the
his books.
ABC Real Estate Investing, as well
Mhm.
as the Advanced Real Estate Investing Guide, I think. But I think Ken did two good books, and really, honestly, I do all the tax returns for us. We do like 1,200K ones a year or something. I process 30 some odd tax returns, so I'm kind of become a little mini tax expert, unlicensed mini tax expert. So also the tax free wealth by Tom Wheelwright gave me a lot
Yep.
of good ideas and concepts that I can go explore with my accountant, and we've been able to implement a lot of the basic principles and strategies to pretty tremendous results.
Awesome. Last question before we wrap. What are your three pillars of wealth creation?
Three pillars of wealth creation, huh? Let me think about that. So, I'm a believer in like real things. I know the government says there's no inflation really, but there's certainly been an asset price inflation, because I know apartments have basically tripled here in the last decade or so, right? So, and
Especially in
rents
Dallas,
are
Fort
up,
Worth.
labor's up, everything's up, right?
Yep.
Insurance is up, my lifestyle's up, everything's up, right? So, I think at some point, even though the headline's not there, I think that at some point, because they keep printing more and more money. So I think if you get real things, so like whether that be precious metals, or whether that be real estate, or whether you invest in your business or your education. I think those are some things that you need to kind of invest in. So, then especially if you have stuff leveraged that produce positive cash flow. What I like about apartment investing, and the business that I'm in, is really, really simple. It's not always easy to go and execute, but at its core, you buy something at a good price that's undervalued, you improve performance and collections, you increase the value, voila, you get rich, especially if you do it leverage, and every
Yeah.
dollar you increase right now is somewhere between 16 to 20 to value. So it's a pretty leveraged business, especially if you're able to go in, put a little bit of your own money in, but then raise money from others and get disproportionate ownership by doing the syndication. And then if you can take over the tax code and become proficient in that, you do all that while paying no income tax. So it's a pretty powerful business. So
Yep.
that's kind of my main business. And then as we're diversifying into like oil and gas, or something else that's a real economy, some sort of commodity, I think at some point when inflation starts coming, that should kind of help protect the money. So I don't know if that answers your question, but that's kind of what I do. And I think the most important thing you do is invest in yourself. So make sure that I'm constantly trying to learn. I'm not the biggest reader in the world, but I'm constantly listening to podcasts or trying to listen to those people that have done more than me and try to constantly tweak what we're doing and either to help maximize what we're doing from value creation standpoint or mitigate as much risk as possible.
Awesome. Well, Michael, how can our listeners get in touch with you?
Yeah, really, there's two ways. The best way, if you really want to learn a whole lot more about me, we have probably 300 podcast episodes. Just go, like I said, Old Capital Podcast. You can search on iTunes, Stitchers, or oldcapitalpodcast.com. Or the way we operate and raise capital is through my company, SPI Advisory. So you can simply just go to www.spiadvisory.com. That's SPI like spy, advisory.com. There's a contact us form. If you fill that out, I'm always happy to have a 10 to 15-minute telephone call with listeners I meet off of either our podcast or other ones who want to learn a little bit more about kind of what we do.
Yeah. Awesome. Well, I appreciate the time and tons of great value. So I think our listeners are going to get a lot out of this episode and definitely appreciate the time you were able to give us.
Well, thank you for having me on. I appreciate it so much, Todd.
Yeah. Have a good rest of the day. Hey, special thanks to Michael Becker for joining us on the show. Appreciate the time he was able to spend with us. And a couple things that I took from this episode, among many, is first of all, it's all about, if you want to scale, it's all about building those relationships. Next thing he talks about is just being intentional, understanding what you want to do and be intentional with everything that you do, every choice that you make. The last thing is he talks about just finding partners, and we talked about it before, building that team, finding partners that are complementary skills that can, help you push to the next level, finding that third-party property manager, finding other partners, other people that can team up with you and really helping you push that next level. Again, appreciate Michael for joining us, and go back to this episode, rewind and decide to write something down, take something from this episode. And I challenge you to take at least one thing and implement into your business today, something that's going to help you push to that next level, and implement that. Make it a choice that you're going to be intentional on doing that activity to get yourself to that next level, to push on. So I appreciate you listening, and enjoy the rest of your day. Make every day a Saturday. Hey, thanks for listening to the show. Couple things before we go. Again, go on to our Facebook page, Pillars of Wealth. We'd love to have you on there. Go on to iTunes, give us a rating and review, and subscribe to the show. Also, don't forget, reach out to me if you want any help with potentially growing your business, and reach out to John Stiles to help you buy or sell real estate. Thanks for listening. We appreciate it. Have a fantastic the rest of the day. And as I say, make every day a Saturday.